Greetings everyone, it's a pleasure to have you again on my channel. Today our focus will be on Cibc, as they recently disclosed their first quarter results last Friday. To begin, we will review the press release, which reveals that the bank's revenue has increased by 10% QoQ. However, they have also experienced a significant decline in their income, which has dropped by 64%. Let's now look at what affected their results. As we can see here, 1.1 billion increase in legal provisions. So this means that the bank has set aside an additional 1.1 billion to cover potential legal liabilities or expenses. This could be related to a variety of legal issues, such as lawsuits, government investigations, or regulatory fines. This increase in legal provisions is actually in connection with a lawsuit tied to the 2008 global financial crisis, and last week Cibc said it would pay 770 million to a vehicle controlled by private equity firm Cerberus Capital Management to resolve the dispute. Second thing we have here is the 545 income tax charge related to the 2022 Canadian federal budget. Means that they are recognizing an expense on their financial statement that they will be required to pay as a result of the changes introduced in the 2022 Canadian federal budget. Now, moving on to the financials. As we can see, Cibc has a steady revenue and income growth over the past 5 years. Here is also the 2022 revenue by core business. Now let's compare Cibc with other major Canadian banks. In terms of revenue, Cibc is currently in the last position when compared to its peers. Additionally, when looking at the net profit margin, it is also behind other banks. It's important to note that these banks compete with one another under the same rules. Another comparison that can be made is by looking at the difference between the actual price and the intrinsic value. Moving on to the comparison of the dividend yield. It's worth noting that Cibc is currently at the top with a dividend yield of 5.3%. This is not surprising as they have been focusing on attracting investors through dividend payouts. Another metric to look at is the CET1, and there are several reasons why CET1 is important. First one is regulatory requirements. Regulators require banks to maintain a minimum CET1 ratio to ensure they have enough capital to absorb losses in times of financial stress. A higher CET1 ratio indicates a stronger and more stable bank. Secondly, market confidence. Investors, depositors, and other stakeholders use CET1 as a gauge of a bank's financial strength and stability. A high CET1 ratio can boost market confidence in a bank and help attract and retain investors and depositors. Third point is risk management. CET1 is an important tool for banks to manage risk. A higher CET1 ratio means that a bank has more capital to absorb potential losses, which can help mitigate risks and protect against unexpected events. Another important metric to examine for banks is the net interest margin. Here are some reasons why NIM is important. First of all, profitability. NIM is a key driver of a bank's profitability. A higher NIM indicates that the bank is earning more income on its interest-earning assets relative to the interest paid on its liabilities. This can translate into higher earnings and returns for shareholders. Secondly, risk management. NIM is also an important tool for managing risk. A higher NIM can provide a cushion against interest rate fluctuations, credit risk, and other risk that could affect a bank's profitability. Third point is competitiveness. NIM can also be used as a benchmark for comparing banks' performance to its peers. Banks with a higher NIM may be viewed as more efficient or better at managing their balance sheet. Fourth point is regulatory compliance. Regulators also pay close attention to banks' NIM when assessing its financial health and stability. A low NIM may be a red flag for potential liquidity or solvency issues. Overall, NIM is an important metric for assessing a bank's financial performance, risk management, and competitiveness. It can help investors, regulators, and other stakeholders to evaluate banks' financial health. And we can see that Cibc comes at the last position. Now let's have a look at the chart. Based on different factors, there are two potential price zones to consider for Cibc. If we are pessimistic about the 2023 economic outlook, the price may fall into the red area. Currently, the price is above the Ishimoku cloud, which suggests that the downtrend has been broken. However, previous behavior indicates that even after breaking the cloud, the price continued to decline. For swing trading, I would advise against buying now, as the price is at a higher high and the RSI confirms this trend. Shorting may be a better option depending on your entry strategy. For investing, if you are still interested in Cibc after what I have shown you, it may be best to wait for a good entry point, as we are currently at a higher high. It's important to remember that predictions of movements are about probabilities and not certainties. It is advisable to wait before taking any position these days, as we are still waiting for the financial results of RY and TD, which are expected to be reported on Wednesday and Thursday respectively. It is is crucial to keep track of the performance of the banking sector as a whole during earnings season. Overall, CIBC is not on my personal watch list, and I will be doing a breakdown of big Canadian banks in my next videos to inform you which banks are captivating my interest. Don't miss this week's quarterly results. Once again, thank you for watching. If you found this video informative and helpful, please consider subscribing to my channel and liking the video to help me with the YouTube algorithm. Your support is greatly appreciated.